Hello, Hinge friends. Hope everyone's doing well today. Thank you for joining us for this fun conversation, growth. One of my favorite things to talk about. I'm Kathy Ligon, and I'll host this content today. Hinge is excited to have you here. For me personally, growth was the very beginning of my career in early education. And I had the opportunity to spend 17 years at a company that I was able to move from a financial role to an operations role and then a growth role. And over those 17 years, we grew from 5 to 120 schools. It was one of the greatest joys of my life. I'm terribly grateful for every opportunity, every person I met, every experience that taught me how to do it better next time and how to support people, what was important and what wasn't, and to really refine that process and then launch that into the creation of HINGE Advisors. So HINGE is 22 years old this year. It is our joy and pleasure to help owners exit after they've grown tremendously. And sometimes we also help them grow by bringing investment partners in. But we love the work that we do with our owners. And this is a fabulous conversation today. So the first thing I would like to do is kind of ask you guys what you're thinking about. If you're here today, you probably have growth on your mind. You're not unusual. As we are looking to our community, the majority of our community is talking about growth. They want to grow. They want to capitalize on this strong time in our industry to add to their school or to consider growth. And just put in your answer here. What are you guys thinking about? One of the things that, so the different types of growth that you might be considering, or you might be considering more than one. So if there are more than one, give us your strongest desire. There's internal growth. Do you just need to be stronger inside your four walls? So we have some ideas today about that. Do you want to expand your current facility? Are you out of space? Could you add more enrollments that way? Do you want to grow by partnering with other entities that are serving the industry that perhaps have a revenue stream that you don't have access to? So we'll talk more about that. Do you want to build from the ground up, commonly referred to as greenfield? If you think about that logically, it's greenfield because the grass is green and you are starting from the grass. So a brand new build is a greenfield. If you are considering renovating a building, maybe it was a childcare building, maybe it was something else, but makes a good conversion, then you're considering a brownfield, a renovation of an existing building. Do you want to acquire? Do you want to acquire something that's already running? That's in my sweet spot right there. And we'll talk about that. Or are you thinking about growing some other way? So you guys are pretty well balanced, with the majority of our respondents thinking to either grow internally. Yay, I'm glad to see that. That's the most important place to start, followed by acquisition. You want to expand your facilities and convert existing real estate. Some of you guys want to grow from the ground up. Love the 4% that want to partner. Very important concept. And use something else. Drop that in our chat bar. What is your something else? Maybe you guys are about to educate me a little bit on what you're considering. So thank you for that. It's really important for us to understand where everyone's coming from as we develop our content and speak about growth in this hour. So if you have something else, help me out with that. I gave you my best ideas right there, so educate me. Okay, so First of all, we want to talk about organic growth. I always start here. Anytime I'm talking about growth, I want to be sure that everyone is completely mindful that you really shouldn't grow outside of your four walls if you're not very stable, very profitable, very successful in your four walls most of the time. Now, there are some exceptions. There are businesses that might be in an area that's aging out, and maybe you do need to go outside of your current four walls to be more successful. But I want you guys to be sure that you have done all the right things inside your current four walls. It could be multiple four walls, but we want you to maximize your enrollment. You guys hear me preachy about this a lot, and you'll see this in the book. But we want you to be 70 to 90% full, with my belief that 70% full is just the beginning of financial health. Your real sweet spot is 70 to 90%, where almost every dollar flows to the bottom line. So I want you to be mindful of that. What you'll see in the book is that of the 5 pillars, there are 2 things you need to think about every single day. There are 3 things you can think about periodically, so that makes it even more simple. And those 2 things are occupancy, or how full you are, and what are my strategies for gaining more enrollments in that age group, and salary control, which is our most important, highest expense line item, and it needs to be managed constantly all day long. The second one is, could you add a new age group? We have some providers who are in communities where there's some universal pre-K in the public schools, and they're drawing 4-year-olds out of the building, really difficult situation. And they have been able, in some cases, to add infant toddler slots that they've never served before, and at a tuition rate where they can do well, where this industry has historically used infants as a loss leader in keeping the children 4 or 5 years and gaining siblings, but it's really difficult at times to charge the tuition rate you need to make that program strong financially. So can you add a new age group? Can you add after schoolers? Can you add a kindergarten? Do you have the demand for a private kindergarten? Can you add a new curriculum? Can you think about STEM or language immersion classes, or Montessori or Reggio, and the things that might differentiate you from your competitors? If you don't have a tremendous amount of competition, I will add that the majority of the national groups have very aggressive new build programs going on right now, and they're moving into communities they've never been in before. And the things I want you to be mindful of there, I don't say it to scare you, I just want you to be at the top of your game all the time. I want you to behave as if a brand new building is coming right down the street from you. Your branding needs to be in place. Your building needs to be in top condition. You need to be at the top of your game with your offerings and what families are interested in. So also, can you partner with an outside entity? Some of you guys mentioned that as a strategy. Head Start, the public schools, businesses, all either operate programs or have a strong interest in programs for their employees. And strategies to partner with them and not get left behind when they open new programs is an absolute must. And even if that hasn't happened yet, get to know them right now. We have clients who, when the public school opened a 4K program, they called our clients and said, we don't know what we're doing here. We know that. We don't know what we're doing here. Please come in and operate this 4-year-old program for us. And it's a beautiful partnership in a building that they provide. So don't get left behind. It's all about the relationship. Meet those people right now. Do you want to expand the building that you're in? Do you want to consider public school after school? So another avenue would be, instead of letting the public school after school program draw your after schoolers out, be the provider in that school. If the school does the program themselves, then you can mention that you'd like to be considered if they ever change their mind. They might not, if it's not a lot of work for them. If they outsource it to anyone, a larger group, the YMCA, the Parks and Rec, you have the right to bid for that program. Distinguish yourself as an educational provider, not a recreational provider, and consider doing that. That's a great, inexpensive way to expand. So summarizing this information, I always like to start with, do everything you can do that's low cost in your four walls, and be as strong as you can be before you consider going outside of your current footprint. So now you've decided to grow. Maybe you want to build a new school. Maybe you want a dark building, dark meaning empty. I'll throw the terms at you. I'm not trying to be confusing. I want you to get to know the terms, because I want you out in your community asking questions and building your own opportunities. And you'll hear greenfield, brownfield, dark, and I want you to be ready with the information to know how to navigate that. So here are some ways to find out when opportunities come. One thing is, let people like us know. We're not the only ones, so let people know in your community if they're advisors or they're brokers or they're realtors. Just let them know that you're interested in growth. Like I mentioned, we have a huge database of buyers, but also we want to know, what are you interested in specifically, and how can we support? Local brokers or local realtors is a really good place to go for information. So local brokers and local realtors very often hear about things that are coming in the market. So be sure that people in your area are aware that you're in growth mode. You'd like to know, you'd like to be considered. Biz Buy Sell, which is a website, is my favorite place for you to go to see local listings. A lot of schools that might get listed in your market, and this is for businesses, will post their offerings there. The team at Hinge doesn't do any public marketing. We're very fanatical about confidentiality, so we don't do that. But you can go into the system. It's a nationwide database. You can register for exactly what you're interested in, and you'll proactively get an email when that listing happens. It doesn't cost anything. So that's a great source of local development and growth opportunities. Existing relationships, I'm gonna, people that just let them know that you're interested in growth so that they will spread that word. This is one of my favorites, landlords. So if you don't own your building and you lease it from a third party, your landlord, let that person, and you've got a great history, landlords love great stable tenants. Let your landlord know, hey, if you ever have anything, I'd like to, let me know if you ever see another building. And very often that person will go out and find something for you. They will even renovate it for you. They might even build it for you. So they're a great source of growth when you have a good relationship. And then your competitors in your local market. So I was just having this fun conversation with a friend owner yesterday who wants to grow. And what you have great reputations in your local markets. And very often you can introduce the idea to a business owner. Maybe they weren't even thinking about it. This happens to the Hinge team a lot. They'll get a call from a buyer and they'll think, well, I hadn't thought about it, but maybe. And then they'll call us and say, well, if I'm going to do this thing, I want to run a process. But if you put the idea in someone's mind, just, hey, how you doing? I have people who will knock on the doors. Hey, how you doing, Mary? I'm Kathy Ligon. I hear great things about your school. I drive by here. It's beautiful. I don't know what your plan is for your business, but here's my card. I would love to talk to you if you ever decide to exit your business. It is a fantastic way to grow in your local market. So I highly recommend that. Okay, let's talk a little bit about greenfield and brownfield development. So one more time, greenfield from the ground up, you got to build super expensive right now. So one disadvantage of greenfields right now is balancing today's very high cost of construction with what parents can afford to pay. So this is outside the scope of this webinar, but you can also find it in the book. I know I'm shamelessly plugging the book. I didn't really mean to do all that, but it is in the book. To balance what your tuition rate is and what the business can afford to pay in rent is a critical factor when you go into a new location. And we have certain metrics. We show you how to project the revenue out when you're 70% full. And then we want to have your rent be a certain percentage of that in a triple net format. Triple net meaning the tenant, you, pays for the property taxes, insurance, and maintenance. So basically, you're responsible for most everything. Sometimes you can push structure and roof and major systems to the landlord. But a disadvantage today of a greenfield and somewhat also to a brownfield is the high cost of construction, which is okay if you can do the calculation and get comfortable that you can charge the tuition rate that will make that metric work. If you're confused about that after you look it up in the book, reach out to us. We're happy just to do some quick math with you and be sure that those numbers work. This is a really hard issue to get past if it isn't done correctly from the very beginning. So that's one disadvantage. One advantage is that it is a big draw. Anytime you have bright and shiny, parent groups absolutely love it. And I say this a lot. I believe that parent groups are more knowledgeable than any time before. This is my 40th year in the industry. And I don't think they still, and why would they? They're not educators, but I don't think they still 100% understand what it is about their children's early education that's important, what is happening, what needs to happen. It's an education opportunity for us. But they will very often look at the facility as a gauge for how well you take care of their children, that this facility is bright and shiny and new, or maybe it's not new, but it's incredibly well maintained. And they might not, I've been in 25-year-old buildings that I thought might be 5 years old. So there is a way for you to really keep your building in good shape. Another advantage would be that you can put it wherever you want. Right? I mean, if you're in a building that has some age on it, you might be in a aging demographic. So moving to a new location gives you the opportunity to grow in a different area. So it could be a new advantage. And then just growth in general, and this is also going to be true of acquisition. If you have a very progressive, excellent team, In order for you to keep them motivated and engaged and moving forward in their path, which is a critical part of our hiring right now, our career paths, you almost have to grow. And I'm also a business owner, so I'm right there with you guys. And, some days I think, okay, enough. And then I create more chaos. As soon as it gets quiet for a minute, I'm like, ooh, let's do this, let's do this. If you're also in that mode, you will attract very progressive people who will almost force you to grow. So it's difficult when you max out one school with a stable long-term staff and there's nowhere for them to go. Maybe they're comfortable, maybe they're not. So that's an advantage to growth. We mentioned before using landlord funds. You can use your landlord to build a new building or renovate an existing building. We're going to talk about financing on the back end. You can partner with someone who will do a build-to-suit project for you. So another term, build-to-suit means I will build a building to suit your needs and then lease it to you. And there are groups out there who will do that and be your landlord. Most companies have to have a little bit of size on them to use this strategy, and they'll typically be with a larger developer or a REIT, or a REIT, Real Estate Investment Trust, which is a larger organization that invests in childcare, in commercial property, and there's some that invest in childcare specifically, so build to suit. And then lastly, of course, bank financing or SBA are avenues for real estate. Real estate's easier to finance than businesses. So those are some thoughts about greenfield and brownfield development. Just to mention one more thing, that the cash flow stream is going to be, it's going to take a while, right? So you need to be prepared to put the investment into the building. Even if someone else builds it for you, you're going to need to equip it. Maybe you need vehicles. You probably need signage, or playgrounds can go in either direction. Sometimes landlords will fund those. Sometimes you need to do that. And then you're going to have a lag time on your ramp. So ramping means how long it takes you to get to basically break even, which used to be about 50%. Now today more about 60%. I really feel like the sweet spot again is 70 to 90%. So how long does it take you to get there? Historically, the industry would take 3 years. It would be there's a saying about it, and I don't know if I can get it right now, but it's leap, grow, go, something like that. Okay, so the idea is that you are going to creep. So that's the first word. You're going to creep along the first year. You're going to maybe break even the second year, and you'll take off the third year. There are providers now who will way past break even in 3 months. So with most people kind of projecting for a year for them to get to full break even. But know what your expectation is and be prepared for that cash drag. That's going to be a disadvantage of green and brownfield development. So one question from Sonia, how much do you recommend having in cash reserves or assets before expanding to another location? We're full with a wait list, fantastic, but we don't have a lot of cash because our profits are low. Okay, so the first thing, I just want to guess that your tuition rates are lower than they need to be. And here's why I say that, because the combination of a wait list, so you obviously have the demand and your profits are low. Your profits are probably low because you're providing more than parents are paying for. Sometimes I get accused of not being sensitive to the needs of working parents, and I've been one. I have 3 children who are working parents. I know how hard it is for parents to pay the cost of childcare. I also know how difficult it is for you to balance everything that's in your expense load. So I would just wonder whether your tuition rates are sufficient to meet the needs of your school. If you are absolutely full and your margins are low, that would be my go-to, because people miss that a lot of times. They work on cost control, and I'm not picking on you at all. I just, you bring up something that is true of so many providers, but they work so hard on their expense management. And I will say this: we're never going to expense control ourselves into financial health. You're never going to expense control yourself there. Your better strategy is to increase your revenue. And for most people, that's a combination of two things. It's increasing the tuition rate. Well, it's occupancy building, but you've got that one covered. And it's considering discounts. So I don't have enough time today to get on my preachy bandwagon about discounts, but it can be a real drain on your financial picture, and the industry has changed in what it's discounting. So that would be something to think about. But to answer your question about how much cash reserves to have or assets to have, I hate to say, but it's dependent on your projection for your new school. So I want you to have enough money or the ability to borrow the money for your hard assets, which would be furniture, fixtures, and equipment, playground, building, whatever you need to do there. As far as cash reserves for your ramp, when I say that average is a year, I want you to be prepared for it to be 2 years. I would hope that you could go into a new building and charge much more, because I want you to have a great projection and know what that looks like. For those of you who aren't familiar, we have a free online benchmarking tool that if you are going to do a new building, you go into it, you put in your expected license capacity, your expected 3-year-old tuition rate. For most people, that's their average. It's your average, but for most people, it's the 3-year-old rate. And then put in 70% occupancy, and it will populate and show you what all the expenses would be on average, including the rent. And you can do that for existing schools as well. So it's framework by hinge.com. Kim is so far ahead of me. Yay, Kim. Thank you. Kim put it in the chat for us. So thank you for that. I think I've got a couple of questions over here too. Hi, Daniel. Sure. Love to talk to you. Have we seen centers be successful growing into primary schools? What are some of the considerations? We have, actually. We've seen some private childcare companies expand in former primary schools, or maybe you mean existing. They both work well. Just like an after-school center in a primary school. So advantages, you get a lot of visibility, right? Maybe they have a ready customer base for you. Maybe they're already equipped. Maybe they will donate the building to you. Wahoo! If we get to remove the cost of a building, or it's under market, under what you would pay in another facility. Similar to churches, some people go into church buildings, and very often, again, those are financially advantaged because of the lower rent. So yeah, we see some of those. Other, disadvantages might be the condition of the school, who's going to maintain it. That would be, I guess my only other disadvantage I might mention would be that when you're in a public school space, if they're also in it, you've got to now juggle basically a business partner, right? So that's a consideration. Hey, Daniel, Kim will drop my email in for you. Love to talk to you after this call. So thank you. Thanks, Kim. Okay, let's talk about acquisitions. So this is my favorite, obviously, because this is what I do for a living. I've also built schools and I've converted buildings into child care centers. So this is really my favorite, and here's why. So if we're going to acquire a school, here was my favorite acquisition story. So you guys heard me say I helped grow a company from 5 to 120 schools. But there was a point at which we grew from 5 to 12, and we kind of did that slowly over time, one at a time. And we built some, we acquired some, we were learning. And then we had the opportunity to acquire, first we acquired 18 schools at one time. And how that happened is KinderCare made the decision to exit the state that we were based in. And so we acquired 18 schools. 1 year later, we acquired 10 more of their schools in a market in an adjacent state. And the point was that we went from 12 to 40 schools in a 12-month period. There is no way that could have happened without an amazing group of directors that we acquired. So for me, it's all about the people. The most valuable asset that you are working toward gaining in an acquisition is the people. The size, of course, as you grow will allow you to hire more people as well who can specialize in different areas of the company. Here's my favorite example of that. When I started and there were 5 schools, I'm an accountant, y'all, but I was ordering the supplies. I was doing the marketing. I was, pitching in the classroom. You guys know what it takes. There was the clogged toilet every now and then. You know what I mean. But as we grew, I was constantly thinking, okay, what my thought process was, what do I hate the most? Because that's generally what do you like the least and what are you the least good at? That's the next person we hire. So as you grow, you're able to add people who specialize in certain areas that you might need. So that's another big advantage. A disadvantage, and the main one from acquisition, is that you are going to have to pay for the value of that business, and that's determined by the cash flow. So business value is determined by cash flow. And it's very specific, and it's based on the amount of cash flow and some other factors about location and quality of real estate and things like that. So that's what we're doing when we do industry specific valuations. But while you're going to have to pay for that, also it's going to come in immediately, right? So it's more predictable. If you are excellent at the transition, and this is your only job, you guys. I mean, there are certain things that you need to be sure you do in an acquisition, some diligence work and checking some things. Obviously, you might have to get financing or you might have to use current cash flow. But the big advantage is that if you transition people well, and by people, I mean teams and families, and mainly teams, because here's what's going to happen. You're going to come in when it's time. You're going to change as little as possible initially. Don't even think about acquiring something that you have to drastically change, because unless you're prepared to replace all the cash flow. But if you win over the team, you work with them to change things slowly over time. All the parents are going to do is look at the teachers and say, is this all right? And the teachers are going to say, yeah, I think it'll be fine. And the parents are going to be fine. So that's kind of how that works. So if you do it well, you can preserve the cash flow, and you can make your cash flow situation much more predictable. So as we talk about greenfields and brownfields, I want you to plan for 4 years, but I want you to, 2 years, but I hope you break even a whole lot sooner. So those are some advantages and disadvantages of acquisition. Of course, with acquisition, you can either acquire just the business and then lease the real estate from whoever the owner is. It might also be, now this is where people sometimes miss a little bit about the fact that a business sitting in a real estate are two separate assets. They're managed separately, they can be sold separately, they can go together, they can be separated completely. So if you acquire a business, perhaps you also acquire the real estate from the business owner if they own it. Perhaps you go in and you say, hey, I'll lease this from you. This preserves your cash and ability to borrow money. Look, I'm a big fan of real estate ownership, so big fan. And I want you to do that when you have the capital to do it. I'm also a big fan of growth. So I want you to weigh those two things. And if it stifles your growth because you don't have the funds to also acquire the real estate, then grow and lease the real estate. That's fine. Maybe you have the ability to purchase it later. Sometimes you're going to acquire a business and the real estate is already leased from somebody else. You're going to have to work that out, probably, depends on what the lease says, but most buyers will want a lease assignment from the landlord to be sure that they're cool, which they generally are. You know, landlords are going to want to be sure that you're stable, and they're going to ask you for information probably. But if the real estate is leased from a third party, you'll need to work that out. You could also go and acquire a piece of real estate with no business in it and put a business in it. Or like we said, you could acquire both at once. So those are some things to think about in acquisition. Acquisition work is challenging in the diligence process, financing and licensing, legal agreements. It is kind of a lot of work, which is why the Hinge team has worked so hard to be sure that we continue to keep up with how that goes. Okay, couple of questions, or one question. Hey, Daniela, do I have the name of REITs you might partner with for new locations who also fund construction or expansions? Yeah, that's tricky. Essential Properties will do a little bit of that, and we're happy to get you aligned with them. The majority of the REITs aren't set up to manage construction projects, so a lot of people will put in place their own construction loan and then try to work with a REIT later. Know about a REIT that they don't like to fund only the risky bits. And you can understand this. So let's say that a provider owns 3 schools, business and real estate. And we've supported a lot of owners like this. And they want to build a 4th. So what we have worked out with REITs in the past is we choose one of the 3 existing buildings that has a good cash flow, stable history, and we've paired that with a new construction that's risky. And then we've shopped that to the REIT community and found the best pricing we could find. That strategy works well because you've given them some stability, and then they're willing to take some risk with you. Where they're not a good fit is when you just want them to take the risky bits. They're risk averse. They won't do a lot of that with you. Landlords are a better source of that, or local investors. But there are a few, and happy to strategize that with you, Daniela. Okay, so acquisitions. I could talk about that one for a super long time. Okay, let's talk, and I'm just going to give you an overview of how business values are determined And this sounds funny, but I'll explain it in a minute how real estate values are determined. Okay, so I'm going to give you the overview, and it's so much more nuanced and complicated than I'm about to say, but I want you guys to get familiar with the terms and learn what you should pay for something, because overpaying for a business or real estate really can just give you trouble for years and years to come, and can have a serious impact on your financial health, and I don't want that for you guys. Okay, so I mentioned before that business values are based on the cash flow. Cash flow currently referred to as EBITDA, EBITDA, EBITDA. EBITDA stands for earnings before interest, taxes, which are income taxes, not property or payroll, depreciation and amortization. And it's just a way for us accountants to make ourselves sound smart. All it is annual cash flow. And it's annual cash flow after the sale. So it's projected forward, but not with growth in tuition. So if you're going to grow the occupancy or you're going to change the tuition rates, you get the benefit of that, right? I don't want you to pay somebody else for what you have to create. A buyer is not going to do that for you. I don't want you to do it. So take the historical revenue, and when you project it forward, you're changing things like, if I'm buying this from an owner, maybe I'm removing their salary, as long as they're full salaries, a director, assistant director, full salaries in the building. Maybe I'm removing the owner's personal expenses like car and insurance. Maybe the rent's going to change. Maybe my insurance is lower, maybe it's higher. So there's some things to think about in projecting it forward. And once you determine what annual cash flow can I make from this business, then you want to decide how many years is it okay for me to pay them before I really start to cash flow, other than the incremental profitability I'm going to create. And it can range from 3 to 20, and it's largely, it breaks along lines of EBITDA, and it's so complicated and there's so many factors that it's really impossible for me to speak to that generically. We dig in very deeply to each situation. But that is how it's calculated. So you want to, again, start with the most recent rolling 12. That means the last 12 months. That's not necessarily a year. So as we sit here in March, it would be March of 24 through February of 25. So it's 12 months, but not necessarily a calendar year. Why? Because you want their most recent numbers. You want to know what their revenue was, what their expenses were for the most recent 12 months. And then you're going to adjust anything that's specific to you. Maybe they didn't have to pay property taxes for some reason, but you are going to. Maybe your benefits are stronger. Maybe you pay more salaries, but you're going to figure out what amount of money can I make off of this business in a year, and then how many times that am I willing to pay? So then you are going to apply that multiple. The multiple means how many years worth. So if the multiple is 3, then I'm going to take the annual go forward cash flow times 3. So that's how it works. What is a reasonable lease amount? Yeah, good question. I'm going to jump over to the real estate slide, and then we'll tackle that. Thanks, Tammy. How about the real estate? Okay, so this is a concept that messes with some people. When you have a business sitting in a building, the business determines the real estate value. So I'm going to dramatic pause on that a minute and say it one more time, because we get a lot of people say, well, I had a appraisal and it was this. The appraisal is going to tell you what the going rate per square foot is in that area. You might have a restaurant, maybe you have other childcare centers. Sure, that might be relevant, but still maybe their tuition rate's different, maybe their revenue's different. So we want to price it based on the ability of the business in it to generate the revenue to pay the rent at a specific number. And so the way this will work, if you get a landlord or a REIT investor, is that we first determine the market rent. So Tammy, what we like to do basically, and I don't have this calculation here, but it's in the book. I want you to calculate out your revenue at 70% occupancy. So a very simple way to do this is go to frameworkbyhinge.com, put in your capacity, your tuition rate, and 70% occupancy. That's and boom, it's gonna tell you at 70% full, I should be making this amount of money. Once you're making that amount of money, our average is 13% of that amount in a triple net format would be an average rent. Now there can be some other ranges. So, I mean, we've seen them as low as 6%. We see them over 15%, or frankly, I get super nervous over 15% of that number. It needs to be a brand spanking new building in a high-end market where you have the ability to increase your tuition rates over the next 5 years. I just feel like that if you get into the range where it's over 15%, it makes me nervous for you. You got to pay that rent no matter what, and I really, really want you to be able to do it at a manageable number right now. So if you were looking at purchasing an asset, a business, or a childcare property, then we're going to back into the property value. Here's how we're going to do it. First, we're going to set the rent. And so instead of the concept where the value of the real estate and then you're going to just decide what rent you have to charge to make that work, we're going to go backwards. We're going to figure out what the business can afford to pay first. That is critical, and we don't want to overpay for this building. So let's do our metrics, calculate out at 70%. The range of 12 to 13% depends on the market, your tuition rates, the quality of the building. There are a lot of factors that go into that determination, but use 13%. It's a good average. And then what we're going to do as an investor who's considering buying this building, and this is how it works if we're going to sell your building to a REIT, the investor who's buying it, so let's call it you're going to buy a piece of property, decides what percent return on my investment do I want. Okay, so you guys probably have assets in cash investments. You probably have some stocks. A lot of people will invest in other businesses, and you kind of know what return on investment do I want. I'm going to use 8% right now because real estate investors can be anywhere from 5 to 12%. It's kind of a range, but there's a good solid average for most people right now of about 8%. It can go higher if it's a smaller company and doesn't have a lot of cash flow and credit build up. Let's use 8%. So I'm going to take the rent that I calculated. I'm going to divide it by 8%, so 0.08. And the result of that tells me how much I can pay for that building and get an 8% return at a lease rate that is healthy for that school. So I'm going to say that one more time. We're going to determine the lease rate that's healthy for that school. We're going to decide what return on our real estate investment we want. Sometimes you're going to have a mortgage. Let's say your mortgage is 8%. Now you got to get a 10% return. So you got to factor that in. But what return do I want? I'm going to divide the annual rent by point, whatever the percent is, in our case, 0.8. And the result will say, in order to get an 8% return and receive this amount of rent, I can pay up to this amount for the real estate. So that's how the investment community determines it. It's how we price. If we were to sell your business in real estate, we would price your business first, and we would set the rent, and then we would determine the real estate value from that rent. We don't actually name values when we sell things because the market's crazy going up right now, and we don't want to leave money on the table. So we let the market determine the value, and we're very often pleasantly surprised. But we want to know internally what our expectation is. So that's how the investment community calculates the value of real estate. Does not matter what they say it's worth. It does not matter what the appraisal said. It does not matter what Mary Sue down the street just sold her property for. So this is how it should be calculated in a healthy way. Okay, pricing structure. You're going to acquire, here's some things to think about that are terms you can think of that will make the cash drain easier for you. And also, if you're ever a seller, you're going to hear these as well. So first of all, you can just pay cash for everything, right? You can pay cash for a business. You can pay cash for a real estate. That's not most people's luxury. So you can. Frankly, our buyers do that because we only work with cash buyers, but they're larger groups and they just have a lot of cash. But that's not most people's reality. A really good strategy is to ask the seller for some financing. As long as you believe you can do a great job with preserving the cash flow, then you can depend on that. An earn-out is a mechanism that says, I will pay you this much in cash at closing, and I'll pay you more a year from now as long as I make this amount of money while I'm operating it. So it's risky for the seller. Now, I got to depend on the new buyer to make that money for me, but an earn-out says, I will earn more money if you do well. And then get some legal advice on the tax differences between whether you structure it as a purchase of the stock of that company or a purchase of the assets of that company. I just wanted to introduce that concept. It's super complicated, and I want you to work with your tax advisor on that. Okay, real quickly, financing, because they're going to drop me out in 3 minutes. So early stage financing, most people start out with a combination of personal savings. They ask family and friends for money. They move to a business partner for business and real estate funds. They use their company cash flow. You got a successful company, I can parlay that into growth. Maybe they have a small credit line to get them started and to use with their ramp. Maybe they use landlord resources. We talked a lot about that. And again, one of my favorites. They use conventional or SBA financing. It's complicated. We used to say conventional was easier, and it used to be, but it isn't anymore. They're both complicated. And again, easier to secure with your real estate than your business. Later on, there are some mechanisms to either sell a piece of property and parlay it into growth, or swap it in a 1031 exchange, which is a tax code designation that just says you can swap an investment property into a new investment property without a tax event. It's a great vehicle, and it's super complicated. And again, I want you to work with somebody like us or your tax professional, because I don't want you to mess that up and then have to pay taxes on it, but it is a vehicle. We talked a good bit about REIT partners, and when you get to the stage where you've got some size, then a private equity investor partner to help you grow with their money is another thing we specialize that is a fantastic growth mechanism. So that's the progression from early stage companies to later stage companies. We touched on a lot of concepts here, guys, and I hope that you heard some ideas that sparked some thoughts for your own growth in your own team, your own personal wealth building, your ability to serve more families and children and grow more teachers. It's the passion I have. I hope it's the passion you have. The team at Hinge is here to support you. If you have questions, we don't need to be a part of everything that you do, and we're happy to brainstorm whenever you have a need. So let us know how you're doing. Good luck with your growth. Take care and be well. We hope to see you soon.